Lyn, hi, happy new year. How are you?
You too. How are you?
Yeah, good. It's weird. It's like I'm wishing you a happy new year and it's March.
Well, because you haven't talked in a while, I guess.
I know. You're too busy. You've been too successful. I barely get to talk to you anymore. How's the start of your year been?
Pretty good. Trying to work on a bunch of different things. My book's taken up a lot of time, so I've been trying to limit my bandwidth wherever possible.
All right. Well, we've got a lot to get into, but tell me a little bit about this book.
Well, I actually I finished the very early first draft. Like I said before, it's a book about money, and so now I have to spend a tremendous amount of time editing it, which is so it's still nowhere near completion, even though it's technically a written book.
Can't you get someone else to do that for you?
Well, I mean, in the final step, I will, yeah. But this phase of the editing is the part where I want to make sure that my ideas are expressed as clearly as possible.
Do you have a title? Can you share it, or is that under wraps?
That's still being worked on.
Oh, damn it. I thought I might get an exclusive then. Well, listen, I can't wait. I will definitely be reading that and I will be pestering you to come on and talk about it. But we have something else to talk about. You've written the most amazing article. So Danny sent me this. Well, he actually texted me, it was about 3 weeks ago. He said, have you read Lyn's latest article about the Fed going broke? I was like, no. He's like, you've got to go and read it. Amazing article. Thank you again. I don't know how you keep producing so much incredible content, but one of the most interesting things for me was kind of like starting to see that those layers of like, we have accounts with the banks have accounts with the feds, and I'd never really kind of got that link, but the relationship between the banks and the Fed is very similar to my relationship with the bank.
Exactly. And actually, this came up a little bit in our euro dollar discussion from a while ago about a series of nested ledgers, right? So a central bank has assets, which, in the older days used to be, say, gold, for example. Now they're, often government bonds, mortgage-backed securities, other things like that. And then they have liabilities, which are the monetary base of that country. And so the United States, the Federal Reserve's monetary base, their liabilities, that's the monetary base of the country. That's basically base dollars. Like at the end of the day, that's what a dollar is. It's a direct liability of the Federal Reserve. And so you can have that in two primary forms. One is physical banknotes, right? If you hold physical cash, it's a direct liability of the Fed. And two, banks store their cash with the Fed in digital form. It's just an entry on the Fed's ledger, and that's a direct liability of the Fed. And so those two components make up the monetary base. And then what banks do is they essentially multiply it. So when you have a deposit at the bank, you have an IOU that is for $1, but they have way more IOUs than they have base cash, because they know that most people are not going to all redeem them at once or even try to. And so you basically have this fractional reserve system. And there's actually, I didn't go in this article, but then the third layer would be international, euro dollar system. Basically, you can have a foreign bank, they have a deposit at a domestic bank, and then they further fractionally reserve it for people that might be holding dollars with them. And so you have a series of fractional reserve IOUs built on fractional reserve IOUs that at the end of the day are a claim on the liability of the Fed, or in another case, if it was Bank of England, whatever the case may be, that liability side of the central bank is the monetary base of the country.
Yeah, and one of the other things which we will get into is it just didn't cross my mind, or I'd never really had it explained to me, but how the Fed actually generates money. I mean, that whole part of the article, how they, what is it, about 100 billion a year?
Sure. Yeah. If you look at a commercial bank for a second before we get into central banks, commercial banks have assets and liabilities, and then they have a thin amount of equity that represents the difference between their assets and their liabilities. And so their liabilities are deposits in various forms: checking deposits, savings deposits, certificates of deposit. They usually pay pretty low interest rates, and that represents our assets, their liabilities. Then their asset side is usually higher interest yielding things like mortgages and other types of loans, as well as various securities like treasury bonds or other types of securities that pay a higher interest. And they make money because their assets pay a larger interest rate than their liabilities, and they also charge various fees, and that basically represents their income at the end of the day. Now, a central bank actually works quite similarly. the bank holds their cash at the Fed and earns interest for it. The Fed also has liabilities in the form of all those bank notes that are obviously zero yielding because they're just physical cash. And then they have an asset side, which consists of government bonds, mortgage-backed securities, sometimes other types of assets as well, that historically most of the time have paid a higher interest rate than their liabilities. But what changed starting last year was that now their liabilities, at least for the Fed, and this I think applies to a number of other central banks, now pays a higher average interest rate than their assets. And historically, the reason why central banks are set up like this is to be somewhat independent. I mean, the idea is that they're not a direct branch of the government. The president can't just give the head of the central bank a phone call and say, "Hey, we have an election coming up. Cut interest rates and boost things a little bit, or we're going to pull your funding." Right? You're supposed to have some degree of separation, even though at the end of the day, the government still sets the terms for the central bank and usually elects people that appoints people that oversees it. But by having longer terms and staggered terms that are different from the current ruling administration of a country, there's some degree of separation, kind of like say a Supreme Court or something like that, like almost like a different branch. And so that's kind of the system we've been operating under. And it's kind of flipped on its head recently.
Well, I think we should just work through the steps of understanding, because we're going to work towards why the Fed is broke or going broke and what that potentially means. And I'm going to make an assumption like the problems that you've identified with the Fed are probably very similar to the Bank of England.
Yeah, you're going to see this in most things. Any central bank that's rapidly raised interest rates is probably in a similar boat to varying degrees. And that's because, historically, we've had 40 years or so of steadily declining interest rates. And so if a central bank holds, say, government bonds from several years ago, chances are that interest rates now are lower than their average assets that were purchased over a period of time and generally have longer average duration. And part of their liability side is zero yielding because of the physical currency part. Right. So they kind of start with an advantage where it's actually pretty hard for their liability side to have a higher average interest rate than their asset side. And if that happened to a normal bank, I mean, that's if a normal bank has basically negative interest income and or if its liabilities exceed its assets, it's basically game over. Whereas a central bank is different. And so right now you have a period where because central banks have raised interest rates so quickly, and for the first time in decades, they have higher interest rates than even the prior cycle, they're at a phase where their liabilities are paying out higher interest rates. And so they have negative interest income. And then this varies based on the bank. But now that interest income is eating away their tangible equity. And so many of them have either on the verge of having negative equity or perhaps some of them already do.
All right, so we'll go through this step by step. I think people always appreciate this when we keep it quite easy. Let's talk about the relationship or how the kind of we call them high street banks. I don't know what you call them in the US, but how they tend to work. And yeah, I'm just going to throw in there, one of the interesting things about this is when I was discussing it with Danny, he brought up the point that's like, we're really just lending money to the bank. We don't realize it. But when we deposit money with the bank or we get paid, we're really giving them an ultra low interest loan.
Yes, that's exactly what you're doing, and basically, it's one of the cheapest source of funding available. I mean, that's a key thing that a bank does is that they're able to borrow interest very, very low, and then they're able to lend it out at higher interest rates and collect that. And there's very different types of banks. There are investment banks, there are commercial banks. Some banks are very simple, some are very complex. But at the end of the day, what their primary purpose is they're providing checking services, they're providing saving services, they're providing services. But at the end of the day, those are a liability for them, an asset for us. And so they're borrowing money. It's actually insurance companies kind of do the same thing. They collect premiums, they pay out claims, but in the middle, they're holding this big float, and they can generate, they can invest that float. They can collect income on their investments by holding things like bonds, and then therefore that's what represents income for an insurance company. And you essentially see the same thing with a bank. Basically, most of the modern financial system that we built up over a long period of time is this kind of arbitrage where banks are arbitraging the fact that they have a bunch of depositors that are coming and going, but in aggregate, most of their total assets, their total liabilities are not changing very frequently, and so they have this kind of permanent low cost source of borrowing that they can lend out for longer periods of time in slightly higher risk capacities. And by having diversification, by having sufficient liquidity on hand to handle withdrawals, most of the time they're fine, and they generate that income, and then they pay themselves, they pay their shareholders. It's basically a big middleman operation, and that's how things work. And obviously, back a long time ago, this was a really valuable service because if you're talking about, like, say, depositing gold coins at a bank and getting like a banknote for them, you're speeding up, you're getting better divisibility, you're getting all these services. Even today, many of us use banks because we're getting something from the relationship. We're able to, connect into this big global set of ledgers, move money around, not have to store a bunch of physical cash like in our home. Obviously, there are some recent alternatives that we can use, like, say, Bitcoin, for example. But prior to Bitcoin, this is kind of the best we have. And so that's the world we live in.
Yeah, I think a lot of people probably don't, well, a bit like the whole financial system, but don't really realize how this works. I mean, I would, if I was super honest, I would have said, certainly when I was maybe like 18, 19, 20 years old, my assumption was when I deposit money with them, they just hold that money and I then access it and they make their money off the services they provide me. And like, I know a lot of those services are now, but provided like close to free. But I don't think people realize that the bank is actually then taking a risk with your money by lending it out. And also in some ways, taking a higher risk by fractionally lending it on a fractional reserve basis, which means that if there is some kind of like global economic crash or some difficult financial situation we go into, there can be a run on the bank and it can risk your deposits.
And that's exactly what happened going into 2008. So in 2007, for example, in the United States financial system, there were $23 worth of deposits for every $1 of bank cash, right? So basically, there's tons and tons of IOUs for every $1 that a typical bank had at deposit with the Fed. Or stored up in vault cash, little in their ATMs or in their vaults, and when that starts to, even FDIC insurance or other types of insurance are not enough to cover massive bank failures. Those are meant to cover if one like bank messes up and they go insolvent, the system has insurance to cover depositors so that there's, so that in a typical operating basis, people don't have to worry about their bank failing as long as they're within those insurance coverage ceiling limits. But if you have a widespread failure where there's all these claims for base dollars that vastly exceed the number of base dollars, and instead, banks have a lot of exposure to risky, illiquid loans that are either unable to be moved around easily and converted back into cash, or if they are at risk of defaulting and therefore losing a portion of customer deposits. And so what they did back in 2008, in part, was that they created a ton of new base money. And they said, well, we're going to create a ton of new base money. We're going to buy some of those assets to reliquify the system. And so, it's not an exaggeration to say it's essentially like a Ponzi scheme. It's just something that has to keep going and keep growing in order to function.
Well, that was going to be one of my next points to you, but I did want to bring up, me and Danny had a guy on the show recently. I think he goes by the name of Regulatory Jason on Twitter. Is that the correct guy, Danny? Jason Brett?
Yeah, Regulatory Jason. Jason Brett, he's called.
Yeah, he worked for the FDIC during the 2008 financial crisis. It was fascinating. And he was playing us a video. And I think what some people didn't realize, is that FDIC insurance is limited. I think it's $250,000. But some people might have had like $20 million with a single institution. And you could lose the vast majority of that. And, and we have a similar insurance in the UK, Lyn. It's much worse. I think it's about £80,000 you're covered for. And, I'm not fortunately one of those people who could have maybe $500,000 in a bank account. But if I did, I would be thinking, well, I need 5 bank accounts here. Because I know you have separate protection for each bank. But I just don't think some people realize that risk. And then when you layer that on, like you said, this is essentially a Ponzi scheme. I don't know any other way to describe it, because if they keep fractionally reserve lending out the money, and they're successful sometimes, or keep bringing more money in, then they've got more, like a higher base to increase those fractional reserve lendings. But like I say, if there's some kind of economic contraction, what happens?
Yeah, what happens is either let's say it was a harder money scenario. Let's say the monetary base was gold, and these were all claims for gold, and you had 5 times as many claims for gold. Then the answer was, some of those claims would not be met. Those would be, defaulted on, and people, thought they had deposits, but they were fractionally reserved, and some of them are gone now. In the current system, because the monetary base is flexible, it's basically just it's a central bank ledger. Instead, what generally happens is if the system starts to collapse, starts to freeze up like it did in 2008, they instead rapidly increase the monetary base. And so you instead kind of spread it out via inflation and currency dilution rather than defaults. And so that's kind of the current era that we're in. And one way when you zoom out, it kind of goes back to that thing, like if a product is free, I mean, you're not the customer, you're the product for someone else being a customer. And so, for example, if you're, there are custodians out there, right? If you're, for example, an ETF is in many ways a custodian. They're holding a bunch of stocks, for example, and they're a wrapper around stocks, and they charge a very low expense ratio to hold those stocks, or if they're an active ETF, to choose which stocks to hold. But even if it's just a passive ETF, they're just following an index, they're basically holding the stocks for you, they're administering the details and charging a small fee for it. And that's a custodian relationship. Same thing if you have gold in a vault somewhere, normally you're paying a very small fee in order to maintain that, because they're not lending your gold out. Their income comes from you as the customer. Whereas if you're not really paying much, or even if you're getting paid, then you're essentially the product. In this case, you're providing a low interest rate loan to them. And the relationship we have with the banks is a little bit of both, because in some ways we do pay fees. We might pay a fee for a wire transfer or something like that, but we also, earn interest, or at least we used to, and now we kind of do around the margins, because we're the ones providing that low cost loan to them. And this is the system we've been in for quite a while.
You're essentially my financial system Jesus. I always refer to you, Lyn, for any questions regarding anything to do with the financial system. But so for me, it'd be really interesting to understand: are there any from your perspective? Are there any pros to a fractional reserve system? Is it something that is beneficial? Is it something that is beneficial but is exploited or abused? Like, how do you generally feel about the idea of fractional reserve lending?
So I generally separate beneficial and harmful as that's one axis versus inevitable or not inevitable. So I think kind of the way I put it is that it's inevitably going to happen, at least with the current and the prior level of technology that we had for the past couple centuries. That is essentially, anytime you have a custodial service, like you're depositing your gold, you're getting claims for that gold at a future date, those people inevitably realize, wait a second, most people don't come and take the gold out at the same time, and therefore I can use this. And then you start to get market pressures, like all these different custodians are holding your gold, and they're all charging fees. And then someone says, wait a second, if I lend 20% of this out, I can generate some income from that, and then I can charge my customers no fees, and they all want to use my service instead of my competitors. And if they don't disclose that to customers, it's fraud. But if they do disclose that customers might say, well, I mean, if you're loaning out 20% of it, that sounds reasonable. If they're, secure lending practices and so forth, it's 80% backed by gold, it's 20% backed by, less liquid loans. Sure, I'll take that trade-off. And then another one might come along and say, we're going to lend out 40% of it. And not only are we going to make the custodian free, we're going to then pay you a little bit as profit sharing. Right. And so there's kind of, I think it's one of those things where if you have a mismatch in speed between the claims and the underlying, right? So gold is slow and bank accounts are quick, you're going to get that arbitrage, and banks are going to make use of that arbitrage. That's why once fractional reserve banking was a thing, it spread everywhere. And so I think it's one of those things where it's inevitable in that current era of technology. Basically, market forces are going to keep pushing in that direction. Whenever they push it too far, it's going to blow up. And so it's less that I view it as good or bad, is that I view it as inevitable. Now, I think there are ways, I think, if you had a bear asset that could settle quickly, there's less of a reason to fractionally reserve it. And basically, whenever it attempts to be fractionally reserved, it's much more likely to break. Because people can pull it out quicker. There's less of a reason to put up with that risk, right? So I think that basically, as technology changes over time, with Bitcoin, for example, I think that can squeeze out the need for it. But I think it's basically inevitable over the past number of centuries that it's going to be there.
And I think that's a really good place where you can almost compare and contrast what's happened with our industry over the last year to 18 months, in that, look, we know what happened in 2008. The banks did fail. And when the banks failed, they were able to be bailed out by the government. Whatever it was, 800 billion in relief for the banks back in 2008. And also the FDIC, insurance does exist as a potential bailout. That when you have, let's call it unsound money, the ability to print to protect yourself, the incentive model allows that. But when you look at what happened within our industry over the last year and a half, nobody could print Bitcoin to protect. And as you said, it's a bearer asset that can settle quickly, and people did try and withdraw, and that's why we saw things break.
Exactly. I think when you have the underlying settlement asset move as quickly as something like Bitcoin does, either fractional reserve banking doesn't make sense, or the ratios that are workable are so much lower than the current ratios we have now that you can get up to, like, say, 23-1, for example. That type of ratio completely goes away when the underlying settlement asset can move very quickly, and you don't really get any advantages other than yield for having it in one of those. So for example, back in the free banking days, besides yield, the advantage you got for putting your gold in a bank is, one, you didn't have to worry about custodying it anymore, and two, you're now tied into this telecommunications connected ledger system, and you can move claims around faster. So you put it in, you get higher velocity from it. But in a world where it is safer to secure the underlying, let's say, for example, Bitcoin multisig, you only have to worry about storing massive amounts of gold in your home. And two, if the underlying moves just as fast as bank ledgers do, then there's less of a reason to ever put it at risk in any sort of fractional reserve way, or at least any significant fractional reserve way. And so I think that's the changeover.
And so is that a reason why the cost of capital is higher when you're trying to borrow from, say, a Bitcoin lender? If you go and look at Ledden's rates or Unchained Capital's rates, they're kind of 11, 12, 13%. Is it because the entire incentive model is different and the risk profile is different and there is no bailout? I mean, it is part of the reason the cost of capital for dollars and pounds is a lot lower, is that there is essentially always a bailout?
I think that's a big part of it. One thing is that rates went up a lot recently. So even in the United States, for example, mortgage rates now are a lot higher than they were a couple years ago. Mm-hmm. But overall, essentially, there's different rates depending on what percentage of the loans you can expect to fail, or the cost of administering those loans, right? It's easier to make a small number of big loans, for example, than a large number of small loans, because you have more overhead costs you have to cover with those interest rates. On the other hand, there's also risk to consider. So, for example, if you're lending money to people to speculate on stocks with, for example, that's going to be pretty high interest rates. Or if someone's piled up credit card debt, you're going to charge them a pretty high interest rate. Whereas if someone is buying a reliable home, if they're doing something that's considered low risk with it, they get a lower rate. So really, it's about the cost of administration, and it's the risk that's being made. And then, of course, there's market forces. If some company identifies a need that is just not being met anywhere, they can charge maybe they can get a lot of money from interest rates because they don't really have competition. And as soon as someone figures out, hey, they're basically a gold mine over there, they can come in and they can charge lower rates, and then that market can go back down to whatever makes sense. So really, it comes down to risk adjusted and overhead adjusted are what determine interest rates for the most part.
So when we look at the central bank How would you say they differ? What are the key differences between them and say like a high street bank that I would use?
So they're one layer down. So basically, they're at the heart of the system, whereas major banks are the layer up. So you have an account with a bank. They provide services for you, and they have assets that back up those deposits. And some of those assets are stored at the central bank, which are liability for the central bank, which are then backed up by things like government bonds or other assets on the central bank balance sheet. So that's the main difference, is that rather than a free banking system where every bank has its own underlying assets like gold, for example, and has claims to them. Instead, most systems around the world are now central banking, which is that they're all connected to the central bank ledger. So that's the one difference, is just the layer. And then the second difference is really about what happens if they go insolvent, right? So, for example, if a normal bank goes insolvent, assuming it doesn't get a bailout, then it's at risk of, basically some sort of liquidation, forced buyout, some sort of thing like that. They have to be basically reconstructed. Whereas a central bank technically can survive with negative equity. And so they don't really have risk of bankruptcy in the same way that a normal bank does. They have different laws that govern their accounting, and they have just overall different constraints. So that's kind of the main difference there.
Can there be a run on a central bank in the same way there is a run on commercial banks, or can a run on a commercial bank lead, like if it was a nationwide economic situation where people were trying to withdraw their money, say like it happened in 2008, can that lead to a run on a central bank?
The short answer is not really. So a bank run can happen in a couple of different ways. The reason a normal bank run can happen is, you don't trust that bank. You're worried they're going to go bankrupt. They're not going to pay you back. So you pull your money out. And you have two choices to do with that money. You can either hold it in cash, or you can shift it to another bank. Let's say you're worried about bank X, but you think bank Y is safe, and so you pull it out to bank Y. A central bank's a little bit different. In one, there's no alternative, at least within that country's currency system, right? So there's no competitor central bank that they're going to rush to. Now, if you look at international situations, that's different. But for example, there's no world where Bank of America, for example, wants to pull out of the Federal Reserve, because what are they going to do with it, right? There's no other thing to put it in. Number two is the central bank controls how much physical currency that there even is. And so they have two sides of their monetary base, which is bank reserves and physical currency. And, you can get a situation, if enough people want to do bank runs, or if you have something like that, there's only so much physical currency out there that they can even pull into. And so if enough people try to do bank runs, you'd actually get told no, even if the bank wasn't bankrupt. Like even if it wasn't insolvent, they would just say there's literally a cash shortage, and we can't meet that demand for your claims being pulled out. And the central bank is what determines, every year, for example, the Federal Reserve tells the Bureau of Engraving and Printing how much physical currency they want to order, to determine basically what percentage of their monetary base they want to be in that physical form. So they, by basically controlling the parameters of what you can even withdraw from, they can avoid any sort of bank run scenario. Now they have other risks or downsides from having negative equity, and there's other risks that they can run into, but a bank run isn't really one of them.
Oh, interesting. Okay, so another thing, can you just explain? I think I must have asked you this like 5 times in the past, and every time I have to get you to come back to it. But can you explain what the reverse repo market is again? Stop laughing at me, Danny.
Sure. A reverse repo is basically if financial institutions or pools of capital have all this extra cash, all this extra liquidity. For example, actually going back to your prior question, or your prior point, a lot of people don't know that if you have too much money in a bank account, it's exposed. It's above the FDIC insured limit, right? So if you have $1 million, where do you stick it, right? You can either stick it in multiple different bank accounts, or you can stick it into something that is perceived as safer. One option, for example, is treasury bills, right? Because your liability is the U.S. federal government rather than a specific banking institution. So you can put $1 billion into treasury bills if you want to. Another option is that you can put them into something like money markets, and they hold a bunch of short-term commercial paper, as well as things like T-bills. And one of the things that they do, if they have all this extra cash, and if the central bank is offering reverse repos, they can take that cash and give it to the Fed, and then they get T-bills in return, right? So they're basically lending money to the Fed and then getting T-bills, and that's basically a way to push liquidity away and get collateral. Because especially at an institutional level, you can do things with T-bills. You can lend them out. You can use them as collateral. And one way to think about reverse repos is, they're the opposite of normal repos, which is essentially that if you're an institution that has T-bills, and for whatever reason you need cash, you need something even more liquid, you can deposit the T-bill with the Fed, get a short-term loan that's collateralized by that T-bill. That's a normal repo, and reverse repos is just the opposite of that. You're giving them excess cash and you're getting T-bills.
This whole thing must be an accounting nightmare. Things must go wrong.
Well, I mean, for example, in 2019, you had the repo spike. That's why the Federal Reserve had to get so active in the repo markets. That's why whenever you have a big crisis, you have a big alphabet soup of programs that arise. So in 2008, for example, there's all sorts of, the central bank had to do a dozen different programs. So they basically add liquidity to the system. They want to make T-bills relatively fungible with cash, for example, to avoid liquidity shocks. And the same thing happened in 2020 when global trade dried up. Everybody still has all these dollar-based debts. So everyone says, okay, we're going to sell T-bills and get dollars to pay our debts. That crashes the treasury market. So then the Fed has to say, no, stop doing that. You can use your T-bills to get loans. We'll buy some T-bills from you with new cash. We'll give you loans based on other collateral. There's other sorts of all sorts of programs that they do because, like you said, this is at the end of the day kind of an accounting nightmare, and it's basically you're administering a gigantic ledger that's always kind of increasing in size and complexity.
Okay, now I think we need to work towards why they're going to go broke or why they are broke, and what that means. So. In your article, you talked about in 2021, the Federal Reserve earned $100 billion in interest income. We talked about that. So, I mean, my first question on that is, why do they target making a profit, and what do they do with that interest that they earn?
So they're not supposed to really do their actions based on making a profit, and they're not incentivized to because they have to give all their excess profit to the Treasury.
Okay.
Right. So basically, the reason that they make a profit is for independence. Like I said before, if they were just an arm of the government, then they would be reliant on funding by the government, and they could be told to do all sorts of stuff right before an election, for example. But instead, by operating, almost like an independent agency, and there are central banks around the world that are publicly traded. It doesn't really mean that much, but they still technically are. They're publicly traded. The Federal Reserve's not, but some are. So you have this degree of independence because they're not on paper insolvent. They have liabilities, they have assets, they generate their own income, they cover their own expenses. And then to avoid them operating in such a way that they're a profit, they have a monopoly, so you want to control their activities to some degree, and so they have to pay their excess profits above their baseline expenses to the government, and so that's historically how the Fed has operated. The Fed's kind of different than other central banks in that it's a public-private partnership, and so it's a little bit more complex. But at the end of the day, it's just kind of this semi-autonomous entity, but that is nonetheless overseen by the government. And so they, going back to the assets and liabilities, their main assets are treasuries and mortgage-backed securities. And their main liabilities are bank reserves and physical banknotes. And so for most of Fed history, their assets paid a higher interest rate than their liabilities. And so after covering their expenses, they earn tons of money, $100 billion, and then they give all that to the Treasury. And so in some sense, you can think of that as, the Treasury has to pay interest to the Fed because the Fed holds a lot of Treasury securities, but then all that money just goes right back to the Treasury. Basically, that almost like that portion of the debt is like zeroed out because any interest they pay on is essentially going right back to the Treasury.
Can I just ask a question? So what's the distinction that makes them independent if they have to give all their profit back to the government?
What makes them independent is that they are self-financing, and so they're required to give excess money to the government, right? They're not. It's not like every year Congress has to authorize money to go to the Fed to pay salaries, for example. Like let's say NASA, the U.S. Space Agency, their operations, their employees are paid by authorizations of Congress. And if for whatever reason Congress just says you don't get money this year, well, they're out of luck. I mean, they just would have to, not operate. They'd have to shut down. Whereas a central bank, because they're a self-generating industry, entity, they're not reliant on these specific, funding authorizations from Congress, and instead they're left to kind of make their own money, but then they have to give excess money to the government. So it's kind of this attempt at decentralization. Now, it obviously runs into limits during war, for example, or major crises. Central bank independence kind of goes out the window to varying degrees, but during most of the time, that is basically an attempt by the institutions that are constructed in order to make it more decentralized than it would be if the central bank was just a direct arm from the government.
Right. And so are there other private shareholders of the Federal Reserve, or is it just the government?
There are. Basically, it's owned by the commercial banking system.
Okay.
And so commercial banks own shares in the Federal Reserve, and they do get a small dividend from that, and they get to pick the board seats of their, the Federal Reserve split into 12 regional Federal Reserve banks, and so they get to pick the majority of the board seats of their local Federal Reserve bank, and then the FOMC, which is the Federal Open Market Committee. That's the entity that determines what interest rates are going to be, what's going to happen with QE, that kind of thing. That's made up from a combination of federally appointed officials, right? So they're appointed by the president and confirmed by the Senate, as well as a subset of the heads of those 12 Federal Reserve banks. And so it's basically this public-private hybrid that is, for the most part, controlled by the federal government, but basically the ownership is officially by the commercial banks. And like I said before, there are some Swiss's bank and Japan's central bank. Those actually have publicly tradable shares that you can buy. So the ownership stake can technically be owned elsewhere, but it usually doesn't mean much.
It all sounds a little bit like, how do I put it? Like an old boys club. Like they all can work together, perhaps collude together, and that doesn't feel like if the commercial banks are shareholders in the Fed, it doesn't feel like it's truly independent.
Well, I guess it depends on independent from whom. It's certainly not independent from the banking system. And when it was made, it was kind of a compromise between the banks and the government. Right? The bank said, well, we're not going to give you all the power. And the federal government says, we're going to take at least some of the power. And that's kind of the arrangement that they came up with. That it partially serves the banks, it partially serves the people, right? Because the people, the one who put Jerome Powell in charge, it's appointed by the president, confirmed by the Senate. We vote for these people, right? So there's basically public representation into the control of the Fed independently, indirectly, and then there's banking input into the control of the Fed. And so basically you have those two directions of power that goes into the Federal Reserve's governance structure. Now, the main benefit that comes from that is that they are independent in a near-term sense, right? So for example, during President Trump's term, he was frustrated with Jerome Powell for increasing interest rates at a time that he felt was inopportune. He would prefer that he did not. He was publicly calling out Jerome for doing that, but it was challenging for him to do anything about it because you had that Powell had his term. He was not doing anything illegal. He's the bank's self-funded. It's not like he can just say, I'm going to fire you if you don't do what I want. And so that's one way that throughout different administrations, throughout time, a president can't just do something right before elections in order to change policy. Now, where it breaks down is, if say a government's debt is going to default or something, or if there's some sort of crisis, some sort of war, they can, Congress can pass a law and force the central bank to do anything. They can say, look, you have to buy our debt, or they can do all sorts of stuff like that. So really, it only gives independence in kind of a short term it avoids kind of that unilateral short-term centralization, but you still have that problem of, at the end of the day, when push comes to shove during crisis, there really is no central bank independence.
Okay, so in September 2022, the Fed began operating at a loss. Again, covered this in the article, and we'll make sure that it appears in the show notes. People really should read it. Was this the first time it happened, and why did it happen?
So this is the first time in modern history.
Wow.
There are some similarities back in, say, the 40s or so, but it's certainly in modern history. This is the first time it happened. And the reason it happened is because, we've had like 40 years of declining interest rates. And so there's never a time where they sharply raise interest rates so much that their liabilities are yielding a higher interest rate than their existing assets. Whereas in 2022, they raised interest rates so quickly that the interest that they're paying on their bank reserves and interest rates that they're paying on reverse repos are higher than the average interest rate that they're earning on their treasuries and their mortgage-backed securities. And so the Fed now has an operating loss instead of an operating income. And so they're now basically, if they were a normal bank, they'd be on the verge of insolvency.
Yeah.
But because they're a central bank, they're different.
When the Fed started raising rates, everyone said that this might be a reason that they couldn't raise them for too long. Clearly, that's not paid out. So why are they willing to go into negative equity to raise rates? Sorry, why are they willing to raise rates so high that they put themselves into negative equity?
One reason is because of the way the accounting's set up, they don't get kind of near-term consequences for having negative equity. And so the way that Federal Reserve accounting works, so right now they're operating a loss. They're no longer sending money to the Treasury because they're not making money to send it to. But then what they're essentially doing is they're eating into their equity. But instead of actually market to market and saying, okay, now we're actually approaching negative equity, they give themselves an asset. It's called basically it's a deferred asset, so that in the future, if they're ever profitable again, they get to pay themselves back first. They get to dig themselves out of this hole before they would resume having to give their excess profits back to the Treasury. And so it's kind of like if you had a business and it starts to go bankrupt, and you say, well, in the future there'll probably be a time when I'm not bankrupt, and so you basically borrow from the future, from my future self to pay back when that happens. That's kind of the thing that the Fed's doing, where they're approaching negative tangible equity, but unlike a normal bank, there's no consequences when they hit zero. There's no consequences immediately, at least when they go negative. And so the main difference is just that they can continue operating, and it's actually the main consequences are for the Treasury. The Treasury now has lost a $100 billion income source.
Yeah.
And even in the future, when the Federal Reserve is profitable again, if they're profitable again, it would be a long time before that income source is recovered, because the Federal Reserve would be not sending remittances to the Treasury because it would be digging itself out of its prior hole before it would ever begin sending more money to the Treasury. So basically, the Federal Reserve is able to do it because the consequences are, for the most part, not on them. They're on the Treasury, they're on the taxpayer, rather than them. Now, if it goes on long enough and kind of to a significant enough degree, you could start raising questions around central bank independence, right? Because if you're technically insolvent, that starts getting that's a different scenario, but that's a long way off. In this sort of intermediate phase, they have virtually zero consequences for this, and the consequences are instead on the Treasury.
So this current situation, is it getting worse? And like, how dire is it?
So it is getting worse. It's probably going to continue for a long time. It's not as dire. So the reason I wrote this article is because a number of weeks and months ago, I started to see basically these doom charts, especially because the St. Louis Fed charting system is kind of broken for this particular metric, and so it looks really bad. And so there are a lot of people sharing that on Twitter. So I actually was inspired to make an article to say, okay, what is behind this crazy chart that I see being shared around? So the short version is there's nothing going to explode because of this, right? There's no near-term or even intermediate-term like wall that they run into for doing this. Instead, the main couple consequences. One consequence is that budget deficits are going to be bigger now because that $100 billion income source just completely vanished and is not coming back anytime soon, most likely. So that's like equivalent to 4 NASA's worth of, expenditure, right? So these days, $100 billion seems like nothing to people, but
Not me.
NASA, for example, is like 25 billion. So the U.S. government lost an income source. That's one tangible consequence from this. On the other side of that, the commercial banking system is basically getting paid pretty well because of this, because all that negative equity is basically draining out of the Fed and going into the commercial banking system. So they're actually making out pretty well. Those liabilities, those higher liabilities from the Fed, those higher yielding liabilities, I should say, that's paying out to banks. So banks are basically getting paid to do nothing. So they don't mind the situation. And the longer term potential consequence is you'll get someone like Senator Warren or others either complain that the Federal Reserve is paying banks too much, or you'll get people started to say like, hey, why do you have this much negative tangible equity? Doesn't that threaten your central bank independence? And so some of the long-term consequences can build up by starting to politicize even more so what some of the Fed actions already are.
And so if the government have lost that income stream, or the Treasury has lost that income stream, is there anything they can do?
The short answer is no. They could cut expenditures, but they're not going to. So instead, essentially what they do is they'll issue an extra $100 billion worth of Treasury securities. And so the debt will rise more quickly than it otherwise would have if this didn't happen. And that's, of course, compounded by the fact that these higher interest rates on the debt are also causing more debt. And so, for example, if they had $400 billion in interest expense, at a lower interest rate environment, they now have like $800 billion in annual interest expense at this higher rate environment. It could go higher than that. And that's now, they're not cutting something to pay for that. Instead, they're just issuing more bonds than they otherwise would in order to cover that. So they're basically increasing their debt load in order to cover up the fact that their interest on their debt is higher and they just lost an income source. So it kind of just builds up over time.
Yeah, it feels like a precarious position because if we look at those layers, the likes of us, we're lending money at a very low interest rate to the banks. They're using that to try and generate an income, but they're using the Federal Reserve or the other central banks as essentially their bank. But they're all operating at a loss. So essentially these central banks, which underpin all money in the global financial system, are kind of insolvent. It doesn't feel like it feels very precarious.
Pretty much, and I think that manifests generally through inflation.
Right.
One thing I like to highlight is that it's very different than 2008. 2008, banks were at risk due to basically deflationary collapse. There's way more claims than there were base money. And so it was a risk of all falling apart. Now, instead, I think the key risk is longer term inflation. Doesn't mean you can't temporarily get the inflation rate down, but it means that as long as these forces exist, the inflation rate's bias is up. And so unless it's actively being held down, it's ready to kind of keep popping up or kind of keep being a problem. And one way to think about it is kind of like how everything's a nested ledger, right? So we have accounts at banks, they have accounts at central banks, and central banks back up their assets with like government bonds. Bailouts kind of happen upward as well. So for example, when in the 90s, you had long-term capital management, a big giant levered hedge fund that blew up. The Fed had it bailed out. That kind of contributed to the dot-com bubble happening. That all blew up. Then they cut interest rates, and then we had this big housing bubble. And when that kind of finally struck, basically the private sector was totally out of ammo. The whole thing, the whole Ponzi was kind of being like started to get mark to market. They basically pulled private sector leverage onto the public sector balance sheet. And so it all kind of wound up on either the Federal Reserve in some cases, or it wound up just right in government deficits and debt. And what we're seeing now is that when all that is held up to the sovereign level, when you have all the debt goes up very high, the only place to kind of release it from there is onto the currency, right? So you get ongoing currency devaluation, ongoing off and on inflation. and ongoing periods of time where however high or low yields are, they're spending most of the time below the prevailing inflation rate, and therefore savers, bondholders, all these types of holders in the system are essentially getting devalued, and that's kind of just spreading out the losses to anyone who's involved in the currency.
And this is kind of like when you said to me on our last couple of interviews, you said the story of the next decade, you said, is probably going to be inflation, and I guess this is why.
It's a key factor, yes. I think that what's going to drive inflation over the next decade is a combination of uncontrolled fiscal deficits by most of the developed countries, and then two, unlike the past decade, there's not really like a buffer for commodities. So there's no real like commodity oversupply and deflationary commodity markets that can offset some of this. So you have the combination of money creation's happening because deficits are high. One way to think of it is that government deficits are a surplus for the private sector. So it's basically it's a way that money kind of pours into the system. And then when you also have tight commodity markets, that makes it so that those increases in money supply do translate into higher consumer prices pretty readily. And that's also true for things like labor shortages. Now, you can have periods of time where, if you get a recession, if they cause a big enough contraction in a period of time, you can get a temporary disinflation. You can get a temporary, contraction. You can reduce demand enough to maybe suppress prices for a period of time. But I think those are going to be, the cyclical things, whereas the structural thing is that inflation, unless, of course, they find a way to sharply reduce deficits, which is, at this stage of the crisis, very, very hard to do.
So in the article, you compare what's happening now with the redeemability of gold in 1933. Can you tell that story? I'd never heard that, and the end of that story blew my mind. I did not know this happened.
Yeah, so I'll tell it in two parts. One is people often ask, why can't a government why can't a central bank just forgive the debt it owns to its government? Like if the Federal Reserve owns a lot of treasuries, why can't there just be a debt jubilee and the Federal Reserve just forgives that portion of the debt because, it's owned by the central bank? Who cares? And the reason is if they did that, the asset side of their balance sheet would be deleted, and they'd still have all the liabilities, right? So they would now have basically no interest income and no assets backing up their liabilities, and yet they'd have all these liabilities. So they would lose their independence. They would rely on funding by the government, and you would not have independent central banking anymore, right? So that's one reason why they can't happen. And so they actually faced a similar thing back in the 30s, which was, back then, the Federal Reserve owned gold, and basically, the liabilities, the monetary base represented claims for gold. You could take your dollar and you can get gold with it at a fixed rate. But because you had a massive banking failure, they wanted to increase the monetary base, but they couldn't increase the amount of gold in the system, and they wanted to centralize all the gold. Instead, they severed the redeemability for gold. They devalued the dollar relative to gold, but then they also said the Federal Reserve has to transfer all of its gold to the Treasury. But they couldn't just do that on its own, because then the Federal Reserve would have all these liabilities and wouldn't have assets, right? So they instead said, okay, we're not just going to take your gold. We're going to take your gold, and then we're going to give you gold certificates that represent the fact that you still kind of own that gold.
Kind of.
But they're not redeemable. Yeah, exactly, kind of. So here's non-redeemable gold certificates. Kinda. And it's what is a non-redeemable gold certificate? It's
bullshit.
It doesn't make sense. It's just and what it is, it's an accounting gimmick. All it is saying that here's a placeholder asset that makes it so you're not insolvent, and that makes some degree of conceptual sense. We took your gold. Here's your claim for the gold. You just can't redeem it, and so that's what kept the Fed solvent for decades. Otherwise, without that gold certificate, that was really means nothing. They would be insolvent on paper because their liabilities would greatly exceed their assets, because their assets, gold, were taken from them. And they actually still hold those today. They used to be a massive part of the balance sheet back when the balance sheet was measured in billions of dollars. But now that everything's so much bigger, those gold certificates they're holding from like 90 years ago are, like something like $12 billion. I mean, they're tiny compared to the size of the Federal Reserve balance sheet today, but they're still holding these meme certificates, 9 decades later. And these like accounting gimmicks that the Fed's using now, where, when they lose money, they instead have these deferred assets. They're kind of the same sort of accounting gimmicks where they're approaching the period where they're insolvent in terms of tangible assets, but by having kind of these imaginary assets fill the gap, it's kind of like magic, and then they're not insolvent.
Lyn, how long can they go on like this for?
I think it depends on a lot of factors. It depends on what happens with commodity markets. It depends on what happens with trust in the system. Right now, for example, whenever you see inflation indicators go higher, usually the dollar strengthens because people say, well, the Fed's got to get tighter then. And so that they'll fix this inflation by getting even tighter. And so it actually strengthens the system. Now, I think when that breaks down is when they're basically so tight and there's still a problem. People say, well, they can't even get any tighter. And then they start essentially selling the system. So I think that the short end of it is that you can still go on quite a bit longer in a similar way that you can look at Argentina or Turkey right now and you can ask, like, why is this still going on? Like, why? Like, if you're having high double-digit, borderline 100% inflation, how is that still going on? And it's a couple of reasons. One is that they don't really there's no clear path to fix it in the countries. And two, they've avoided collapsing to the point of say a Lebanon or like an outright failed state. They're kind of in that intermediate state where you're still you're still able to function in these countries, and just the money system is just broken, and just month after month, quarter after quarter, year after year, it's even more broken. I think you see a light version of that today in a lot of developed countries where it's kind of broken, but it's not broken so bad that it leads to an outcome next week, and so it just kind of keeps grinding on. And so I think that basically it's going to be a multi-year story of just inflation on average is going to be higher than the target level, and there's going to be various kind of reasons why that is, debates about why that is, what the Fed should do. There might be periods of time where they get it under control, often probably ironically because of a recession. And they say, well, I mean, we caused a recession and we got inflation down, and then you try to grow back out of that recession, and then you get inflation again. So it's almost like it can go longer because it's not a straight line and it's nowhere near hyperinflation. So you get that kind of long grind. And so I think it can go on until you start to get really, really negative tangible effects. And so, for example, one deadline is that by around the year 2035, Social Security goes bankrupt. And so what that would mean is that not that they have zero payouts, but that they can only pay out from incoming tax revenue, which is insufficient. And so you'd have to basically do a haircut for Social Security payouts, which would, of course, piss a lot of people off. And so in the run up to that, you'd have a big issue. Or alternatively, they could increase taxes, but then you'd get another group of people would be pissed off. And so there are these kind of deadlines where certain things literally run out. But in the next several years, it's just kind of this ongoing background problem that people live with in a similar but less extreme way than people live with it in Turkey, Argentina, and a lot of these other types of countries.
So I just want to make sure, by 2035, with current projections, Social Security goes bankrupt?
Yes.
Wow.
So the way it's been working is that basically they've had a surplus, and they store that in treasuries, actually. It's non-marketable treasuries. So they actually earn interest on their savings. And just actually right as last year, instead of that surplus going up, it's starting to roll over and go down. So now the program is so top heavy that they're paying out more than they're getting in, but they do have those savings to draw from. And so basically over the next, call it 12 years, and sometimes the estimate changes. They used to think it was going to be 2034 and then it's 2035. It's not big changes, but there's a slight amount of variance for exactly when this happens, but roughly around 2035, that it's about $3 trillion currently that surplus that'll be drawn down, and then you have a situation where you're already at this point, taxes are not covering the payouts, but there's no reserves to draw down either, and so you'd have to cut payouts or increase taxes, some sort of resolution to that outcome. And that's basically it's a somewhat different budget process than the rest of the fiscal budget.
We sound so fucked. Excuse my language, Lyn, but we sound so fucked.
I mean, I think the way this likely manifests over time is you get greater and greater political polarization.
Yep.
Greater and greater just differences in opinion on how to handle that, right? I mean, there's actually some people that are like, no, you have to raise taxes to keep paying for this stuff. Other people are going to say, no, you have to cut spending because taxes can't go any higher. And it comes down to like either checks are going to get sent or not. I mean, we have a smaller version of this every couple of years with the debt ceiling debate, which is what we have this year coming up. So that's kind of a nearer term version. But then the longer term version is that fiscal spiral that you have over 100% debt to GDP. You have interest on that debt. You have ongoing pretty large deficits, and you have real world constraints in terms of labor, in terms of commodities and things like that. And so basically the public ledger is broken. That generally manifests in inflation, and how high that inflation is partially depends on economic growth, commodity availability. Maybe we have gigantic productivity breakthroughs and we push this out longer, or maybe we have war and we pull it up sooner. Right? There's all these factors that can influence the timing and the magnitude of what happens. But essentially, when you have these structural massive deficits and high debts, it generally manifests in inflation grinding on over time until you have some sort of political consensus to figure out how to balance that out, which generally only happens after a lot of damage has been done and after a lot of those debts have been effectively inflated away.
So how are you planning for this? Where are you putting your money, Lyn? That's what everyone's thinking. And by the way, just sign up to Lyn's newsletter. She tells you everything you need to know.
I mean, the short summary is that I emphasize hard assets, right? Or I'm long things that are scarce, and I avoid or I'm short things that are not scarce, right? So I own things like energy pipelines, energy deposits, good cash flow producing companies, gold and Bitcoin, right? And then I either avoid things like holding massive amounts of cash, or I have a low interest rate mortgage, for example, so I'm effectively short the currency. Now, in periods of time, like if I think, for example, they're going to tighten so much they're going to cause a recession, then cash could be really good for like, a 12 to 18 month period because everything else does worse. So there certainly are periods of time. Like right now, I think I have some cash. Basically, I focus on hard assets, but I also focus on diversification and maintaining liquidity so that if there are these kind of periods of volatility, I can rebalance into those things. And it partly comes down to not being able to know the future. And then two, you have to kind of take actions that come and go. I mean, there could be regulatory actions against something like Bitcoin. There could be, wars that break out. So it's basically just diversification into a number of things that I view as being scarce and useful, and avoiding things that I view as being abundant or not useful.
It's like Lyn's time, Danny, these days. Scarce asset. Lyn, wonderful as ever. When do we get to see you in person next? Is it going to be Miami?
It looks like it's shaping up that way. Yeah.
All right. Well,
I'd be happy to see you there.
Yeah, I would love to see you. It's been too long. We're all getting too busy now, and we don't get to see you as much anymore. But looking forward. Oh, you missed the start, Danny. We were talking a little bit about Lyn's book that's coming.
Are you writing a book?
I am writing a book. Yeah, I actually have the very, very first draft written, and now I'm in the long editing phase, which is it's still nowhere near completion, even though it's technically written.
Very cool. I've got one question before. I know we're really short on time. But at the end of the article, you kind of leave us on a bit of a cliffhanger, talking about how interest rates typically are seen as like a way of quelling inflation, but you say that might not be the case. So what's this next article?
It might not be the next article, but it's an upcoming article.
Okay.
And I've already mostly written it, that talks about the relationship between interest rates and inflation. So basically, when you have high inflation, one of the ways that people want to deal with it is higher interest rates, right? Because you say, okay, well, there's too much inflation happening, so you have to raise interest rates, hurt asset prices, slow down bank lending, and that'll slow down money creation and therefore slow down inflation. That was basically one of the steps to do in the 70s, and that works as long as lending-driven inflation is the major part of why inflation's happening, why the money supply is increasing. That does not work very well if large fiscal deficits are what is driving the inflation and driving that money creation. And so, for example, in the 1940s, when you had massive, the highest inflation the United States ever got officially was 19% year over year, and that was in the 40s, and we kept interest rates at roughly zero. Because that inflation was not caused from bank lending. Banks were barely lending at all. Instead, it was the large fiscal spending on the war. And so I think one of the challenges that policymakers are going to have during this upcoming years and decade or so is that when they increase interest rates to try to quell inflation, they actually increase the federal deficit, right? Because there's higher interest expense that they're paying out on the same amount of debt. And that actually pours into the economy as a form of money creation. And so on one hand, you're trying to control bank lending driven inflation, but you're making the fiscal inflation worse. And if you have an environment like we do today where fiscal driven inflation is the bigger component of money creation than bank lending, then you can actually get a situation where higher interest rates exacerbate inflation rather than make it worse. Or you can get a period where higher interest rates, temporarily push down inflation, but then over the long term exacerbate it. And so really the only way to fix inflation when you have fiscal driven inflation over the longer term is to reduce those budget deficits. And so as long as they don't reduce those budget deficits, it's probably going to be a recurring problem regardless of what interest rates are.
Maybe that's what we can cover in Miami in May then.
Yeah, I'll definitely have the article out by then.
Well, Lyn, thanks as ever. We only break our in-person rule for you for obvious reasons. But it's great to see you, and cannot wait to find out and get a copy and read this book. There's too many good books coming out at the moment. Anyone listening, you're going to have to buy Lyn's book as well as sign up for an email. And we look forward to seeing you in Miami.
Yep, looking forward to it. Thanks for having me.
Thanks, Lyn.
Thanks, Lyn.